Hey guys, welcome to Pounds Invested. I'm your host, Stephen Georgiev. Before we get into today's video, I really want to thank my subscribers and also those of you who have seen my videos before. If you're new here, make sure to like this video if you enjoy the content and subscribe to the channel for more stuff like this. Now, let's get into today's video. So, in today's video, we're going to look at the distinction between the stock market and the wider economy. Now, as I'm sure you'll all be aware, the stock market is a collection of some of the world's biggest and most recognizable companies. Basically, companies like these. So, in theory, here's what happens. When people are feeling good about themselves and they have money to spend, they spend that money in shops. And then the companies which they buy their products and services from see their share prices rise as a result of consumer confidence. The opposite is also true. When people are feeling less happy about their prospects, they go out less and they spend less money in the economy, and so share prices decline. But what happens when you forcibly shut down an economy for a few months on end? How does that affect stock prices? Well, logically, you'd think that because people aren't able to go out and spend money, share prices would decline across the board, right? That would be the logical explanation. But is that really what's happened? Well, as we can see from this chart right here, it's actually not, no. In fact, after a few weeks of initial losses, the opposite has happened, and the wider market is now above where it was pre-pandemic times. But why is that the case? There are fundamentally three reasons why the stock market is so high, given the fundamentally bleak picture in the wider economy. 1. FAANG. F-A-A-N-G. Facebook, Apple, Amazon, Netflix, Google. These companies, whose business models are in fact well suited to an economic shutdown. Why? Well, because people, when they're at home, they'll log into Facebook, they'll buy things from Amazon using their Apple devices, they'll log into Netflix, and of course, who can go a day without using Google nowadays? So, for these and a few other tech companies, the pandemic and the ensuing shutdown has actually been a blessing in disguise. So much so that looking at this next chart, we can see that if we take out these and a handful of other big tech companies, the performance of the S&P 500 since the pandemic would actually be negative. Yes, negative. All of the economic outperformance of the S&P 500 is in fact down to just a handful of big tech companies. So, the second reason why the stock market is so high is because of an unprecedented amount of government intervention, specifically by the Federal Reserve in the USA, the European Central Bank in the EU, and the Bank of England in the UK. These and other central banks around the world have collectively pumped trillions of dollars worth of new money into the economy. So much so that some commentators have in fact said that this action amounts to a bailout of the stock market. Now, as we'll come on to in a few minutes' time, stock market performance very much relies on favourable green light signals from the government. In short, when central banks and the government flash that green light, that positive news signal that everything's going to be okay, stock markets take that good news and they react to it by going upwards. Another way of looking at this signalling idea is that by signalling that everything's going to be okay and pumping trillions of dollars into the economy, what central banks and governments are trying to do is to reassure investors that their investments are going to be fundamentally sound. And by doing so, what they're doing is also inspiring confidence among everyday consumers. And the third reason why stock markets around the world are at or near record highs, despite the bleaker picture in the wider economy, is because stock markets tend to be forward-looking. What does this mean in practice? Well, it just means that stock market prices are based on investor predictions about how companies are going to do in the very near future. As a result of this, stock markets will increase in value 12 to 18 months before the real economy, businesses in the real world, actually start to feel like they're coming out of an economic slump. Why is this? Well, like we said, it's simply because investors are betting that the long-term prospects of the global economy are going to be sound. But has the injection of all of this artificial money caused a false sense of security among investors? In other words, is it time to start panicking? Well, yes, but also no. On the one hand, there are things like what's colloquially known as the Buffett indicator. What the so-called Buffett indicator does is it takes the total amount of US stock market value and divides that by the total amount of US GDP. Now, in an ideal world, you'd expect that the total amount of stock market value in a country is lower than the total GDP of that country. Why? Well, because not every company in that country is going to be listed on a stock market. And so stock market values can never take a full picture of the GDP of a country because there are so many more variables in the GDP of a country than just the stock market values. With that said, guys, we can see by looking at the Buffett indicator, or to give it its official name, the Wilshire 5000 index, that the total value of all the US stock markets put together is about 1.6 times the total value of the US economy as a whole. Now, that's worrying in one sense, because of course, like we said, the total US economy is much more than just the companies which happen to be listed at any one time on its stock markets. The total of the US economy is all of the stock market value plus all of the companies which aren't listed on the stock market. So the ideal correlation between a stock market value and a country's economy should be lower than, but around about 1. That would mean that the total value of a country's stock market is lower than, but roughly equal to, the total value of that country's economic output in any one year. So should we be worried that in the US it looks as though the stock markets collectively are around about 1.6 times the size of the US economy? Well, on the one hand, it's cause for concern, because as central banks have pumped trillions of dollars into the economy to stabilize stock market values and other asset prices, what that's done is in our fraction, it's inflated the numerator so that the stock market values are much higher than they would otherwise have been, while at the same time the COVID-19 shutdown has squeezed the denominator in the fraction so that the size of the US economy is in fact much smaller than it would otherwise have been. As such, it's perfectly predictable that the fraction is going to be top heavy, and so it should not come as news that the US stock market is far, far larger than the total size of the US economy. So, we can see that because of central bank action to prop up asset prices, the fraction is completely out of kilter. But is that really a problem? Well, I'd probably argue not. Why? Well, because the companies which have to some extent been bailed out by the central banks are still vastly profit-making. Facebook, Apple, Amazon in particular, Netflix, and also Google have in the past couple of quarters announced billions of dollars of profits. And so, because these companies are still profitable, then you could well make a convincing argument that they're not overvalued. And let's remember, guys, stocks and stock markets generally tend to stay high for as long as investors believe that they're undervalued. As soon as investors start reading the signals into stock market prices that those companies are fairly valued and then later on become overvalued, stock markets will start to react in a negative way and we'll see drops. But as of yet, nobody has invented a crystal ball. In fact, among large stock market investors globally, the hope has to be that a COVID-19 vaccine is developed and distributed before central banks run out of steam and investor confidence starts to slump. This is because if we can develop and distribute an effective COVID-19 vaccine while stock markets are still high and investors and the general public are still confident about their prospects, we could end up riding the wave of central bank money such that there is no downturn. Investors end up being proven right that there's going to be a quick recovery at the other side of the COVID-19 pandemic. So until then, guys, the advice has to be keep your investments diversified. Keep a 6-month emergency fund on the side, just in case things turn hairy over the next year, year and a half or so. And above all, keep playing a long-term game. Those 3 things are going to be the 3 things that determine the profitability of your portfolio. much more than the fortunes of a handful of tech companies over the next few years. So guys, I hope you found this video useful. If you did, be sure to smash the like button and also subscribe to this channel for more content like this. Now, my next video is going to shine a spotlight on something which we've seen more and more of over the past few months: stock splits. To find out what stock splits are and why companies like Apple and Tesla have recently carried them out, be sure to check out my next video in a few days' time, and I'll see you then.